Hello everyone, it's day 34 and today I have April 6, 2024 Indian Express newspaper and there are few important articles, not few but one important article over the explained page and one important over the editorial page. So we'll try to cover both of these articles. So first article is on the Indian Express explained page, that is page number 9, and this is about the green hydrogen push. So as we know that hydrogen are of many types: green hydrogen, blue hydrogen, white hydrogen, etc, etc. But government is mainly focusing on green hydrogen because green hydrogen doesn't produce any kind of greenhouse gas. So let us see what green hydrogen push is about. So government has announced a scheme to support efforts to test the viability of green hydrogen as a fuel for cars and heavy vehicles. Green hydrogen presents both a big opportunity and some major challenges. So there are few important types of green hydrogen. Types of hydrogen are being given in a box. So let us see. So first is gray hydrogen. It constitutes the bulk of India's production currently. It is extracted from hydrocarbons, fossil fuels, and natural gas, and carbon dioxide is the byproduct of consumption. Blue hydrogen is the also sourced from fossil fuels, but byproducts such as carbon monoxide and carbon dioxide are captured and stored, so it is better than gray hydrogen. And last is green hydrogen. It is an end-to-end green fuel. Electricity generated from renewable sources such as wind or solar is used to electrolyze water. Byproducts of are water or water vapor. So this is the better source for when it comes to the hydrogen. The Ministry of New and Renewable Energy has announced a rupees 496 crore scheme to support pilot projects that either test the viability of green hydrogen as a vehicle fuel or develop secure supporting infrastructure such as refueling stations. Big Indian commercial vehicles manufacturers such as Tata Motors, Volvo Eicher, and Ashok Leyland are doubling down on efforts to develop hydrogen powered trucks and buses by ramping up research and development and building manufacturing capacities. Indian energy companies too are trying to scale up the production of green hydrogen and bring down the cost to make it affordable enough to compete with other fuels. Hydrogen is expected to be used widely in the transportation sector in the coming years, and as a large and growing market for both vehicles and energy, India stands to gain significantly from the large scale adoption of green hydrogen as vehicular fuel. Green hydrogen promises significant reductions of emissions to help slow global warming and climate change. India sees advantages ranging from curbing pollution and meeting its climate goals to reducing costly fossil fuel imports, as well as business opportunity to become global hub for the production and export of green hydrogen. So, what is green and gray hydrogen? Hydrogen is colorless, and green hydrogen is green only by virtue of the way it is produced and the source of the energy used to manufacture it. Green hydrogen refers to hydrogen that is produced from the electrolysis of water, splitting it into hydrogen and oxygen. Using an electrolyzer powered by renewable energy, this is considered to be a virtually emission-free pathway for hydrogen production. It is end-to-end green because it is powered by green energy, uses water as a feedstock, and emits no carbon on consumption. Currently, most hydrogen produced for industrial consumption and application is gray hydrogen, which is produced from natural gas through energy-intensive processes and has high carbon emissions. Except for difference in the production pathways and emissions, green hydrogen is essentially the same as gray or hydrogen characterized by any other color. So, transport sector scheme. The major objective of the Ministry of New and Renewable Energy scheme guidelines for which were issued in February include: first, validation of technical feasibility and performance of green hydrogen as a transportation fuel; second, evaluation of the economic viability of green hydrogen powered vehicles; and third, demonstration of safe operation of hydrogen powered vehicles and refueling stations. The Ministry of Road Transport and Highways will appoint a scheme implementation agency that will invite proposals for pilot projects. The select company or consortium will be project's executing agency. Based on the recommendation of the project appraisal committee, the Ministry of New and Renewable Energy will approve viability gap funding for the project. The viability gap funding amount will be finalized after considering specific needs, merits, and feasibility of each project. The executing agency will be required to complete the pilot project within 2 years, not 2 days, 2 years. Hydrogen fuel cell vehicles. A hydrogen internal combustion engine vehicles utilizes hydrogen through combustion, which is similar to cars running on diesel and petrol, except there are no carbon emissions. A fuel cell vehicle, fuel cell electric vehicle, utilizes hydrogen electrochemically by converting hydrogen stored in the high pressure tank into electricity, leaving water as a byproduct. Even though hydrogen ICE vehicles do not emit carbon, research suggests that burning hydrogen is far less energy efficient than converting it into electricity in a fuel cell. Compared to battery electric vehicles, in which battery is the heaviest part, hydrogen fuel cell electric vehicles are typically much lighter because hydrogen is a light element, and a fuel cell weighs lesser than an electric vehicle battery. This makes hydrogen fuel cell technology a viable alternative to EV battery technology, especially for heavy duty trucks that can benefit from an increased payload capacity without coughing clouds of smoke from the burning diesel. Indeed, research shows that long haul FCEVs can carry freight amounts similar to diesel trucks, whereas long haul BEVs have a weight penalty of up to 25% due to heavier batteries. Given the need to cut the carbon emissions in the transportation sector while ensuring there is no loss in revenue generation payload capacity, green hydrogen holds promise. A number of challenges. So there are significant challenges to the large scale use of green hydrogen in the transportation sector. The foremost among these is the prohibitive cost of production, followed by the challenges of storage and transportation at scale. With more innovation in technology and scaling up of production, though costs are likely to come down in a few years. Green hydrogen powered vehicles are not yet seen as a suitable alternative to four-wheel BEVs due to challenge arising from fuel cost and building supportive infrastructure. Shell, a pioneer in hydrogen refueling technology, last month announced it was shutting all its hydrogen refueling stations for cars in California due to supply complications and other external market factors. Hydrogen filling stations for heavy duty vehicles, however, continue to remain operational there. For hydrogen FCEVs to compete with BEVs, green hydrogen needs to cost between $3 and 5 and $6.5 per kilogram by 2030. For perspective, retail green hydrogen prices in California touched $30 per kilogram in 2023. Also, the California Transportation Commission estimates that building a hydrogen truck fueling station costs up to 72% more than the cost of building a battery electric truck fueling stations. The MNRE plans to convene a meeting with stakeholders to discuss the development of a specialized cylinder to store green hydrogen after manufacturers of commercial vehicles flagged challenges related to high pressure storage cylinders. Currently, most cylinders manufactured in India are designed to carry compressed natural gas, but hydrogen is stored at a much higher pressure and CNG cylinders cannot carry hydrogen. For cylinders to carry a high mass of hydrogen, the carbon fiber needs to be stronger, which makes high pressure hydrogen cylinders expensive. This is a key barrier to the adoption of hydrogen as a transport fuel. For the same reason, the existing natural gas pipeline infrastructure is also not seen as viable. Hydrogen is extremely flammable, which means that special care would be needed to handling the fuel at retail stations compared to diesel, petrol, or even CNG. Robust and foolproof handling and safety standards need to be developed before pushing large scale adoption. Finally, as advancements in battery technologies continue to reduce the overall weight of EV batteries, the long term viability of green hydrogen powered heavy duty commercial vehicles could also come under pressure. So, this was about the green hydrogen push. So, we'll try to cover another article on the editorial page, that is page number 10. So, this was about the fear of inflation and the recent the bi-monthly policy of the RBI. So let us see what it is about to say. This article is written by the chief economist of Chrysler Limited, Mr. Dharmakirti Joshi. So this title, waiting for summer, and fear of inflation keeps RBI from cutting rates. Poor monsoon, oil prices could throw a spanner in works. So the Reserve Bank of India's non action on April 5 was par for the course. With the growth stronger than expected and inflation above target, the market expected the RBI to stay put on rate action as well as its stance. The second advanced GDP estimate released in February had shown that economy ticked at over 8% in the first three quarters, lifting the fiscal growth to 7.6%. High frequency data shows the momentum has continued into the fourth quarter. The Composite Purchasing Managers Index for March at 61.8 Purchasing Manager Index was in a very strong expansion zone. Direct and indirect tax collections have exceeded targets with the solid performance continuing in the March. The highlights of the resilience of non-farm sectors, particularly construction, manufacturing, and financial services. Agriculture growth, though, was an anemic 0.7% in 2023-24. Okay, viewed from the expenditure side, GDP growth has been largely investment driven, with private consumption growth trailing GDP. That said, private consumption, vital for balanced and sustainable growth, will remain a key monitorable. CRISIL expect India's GDP growth to moderate to 6.8% in the current year. The transmission of the RBI effective rate hikes between May 2022 and February 2023 is underway and is likely to modestly weigh on the demand in 2024-25. Regulatory actions to tame unsecured lending will also have a bearing on credit growth. Additionally, a lower fiscal deficit will mean a lower fiscal push to growth. A lower fiscal deficit, okay, a lower fiscal deficit will mean lower fiscal push to growth. Despite the expectation that growth and inflation would moderate in 2024-25, the RBI has been wary of declaring an early victory. Governor Shaktikant Das noted that the last leg of disinflation has proved to be a difficult one across the world. Strong growth perspectives provide the RBI policy space to remain focused on inflation and ensure its descent to the target of 4%, he said. Mint Road retained its February forecast of 7% GDP growth in 2024-25, marginally higher than the crisis expectation. Inflation is projected to drop to 4.5% in assuming a spell of normal monsoon and range bound crude oil prices. The India Meteorological Department believes that the El Nino's impact will fade by the second half of the year, and La Nina condition associated with abundant rains will set in. This will help cool the food prices, which has been the key worry. Food inflation has averaged 7.4% in the first 11 months of this year, whereas non-food inflation was only 4.1%. The latest print for February showed food and non-food inflation were at 8.7% and 2.9% respectively. Core inflation computed, okay, so core inflation computed after removing food and fuel from the headline inflation was at a benign 52-week low of 3.4%. Within food grain inflation softened somewhat, but vegetables inflation has stayed high and volatile, flaring up to 30.2% in the February and 27.1% in the January. The RBI can generally look through vegetable inflation since it is volatile. Moreover, vegetables have a short crop cycles and their prices correct fairly quickly. However, vegetable prices shocks have been quite persistent this time, keeping inflation in this category high. The bigger worry has been food grain inflation, which, despite softening, was still at a high of 9.88% in February. While central bank policy moves cannot bring down supply shock driven food inflation, it can prevent high prices from traveling to non food inflation, especially when growth is high and the food inflation persistent, as in India. Another worry stemming from food inflation is that it hurts the lower income deciles more than the upper ones. Our calculations our calculations show in February the bottom 20% of the urban population faced 5.5% inflation compared to 4.7% faced by the top 20%, since food has a higher weight in their consumption basket. The pattern in rural area was similar. This should correct with softening of food inflation in 24-25. How high food inflation is likely to have contributed to weak consumption demand since it erodes discretionary spending of households. The government's free food grain program does provide a cushion to low income households, but overall reduction in food inflation uh, will bring bigger relief. Expectation of normal monsoon, healthy agriculture, and lower food inflation will be a positive for rural consumption this fiscal. After food, let's turn to fuel. In our best case scenario, in our base case scenario, we do not expect any significant risk to fuel inflation since crude prices will likely to be 80 to 85 dollar per barrel in 24-25. However, the recent surge in crude prices is in an uncertain geopolitical setting does raise some concern. The Federal Reserves and the European Central Bank have not been in a hurry to cut rates since headline and core inflation remain high despite the softening trend. In its March March meeting, the Fed hinted that it would cut the interest rate in the coming months. S&P Global believes inflation will likely remain above the Fed's target of 2% through 24, reflecting persistently higher service price inflation even as goods prices ease modestly. We expect the Fed and ECB to initiate rate cuts in June. To be sure, India's monetary policy decisions are based more on domestic conditions and inflation dynamics than on US rate moves. But in an interconnected world, rate cuts by systematically important central banks do nudge rate cuts in emerging markets. S&P Global expects Latin American emerging market central banks that have already cut rates to continue with the same through this year. Central banks in emerging Asian economies will likely start cutting rates in the second half. The other good news on the rate front is that fiscal policy is unlikely to come in the way of rate cuts due to the improved coordination between the fiscal and monetary policy. The interim budget focused on fiscal consolidation by aiming to cut the fiscal deficit to 5.1% of GDP this year. Going by experience, the budget post the election is unlikely to change the fiscal stance if the government returns to office. The overall macro investment is turning conducive for central banks to begin cutting rates by end of summer. For India, though, a poor monsoon, extreme weather events, and crude oil prices could throw a spanner in the works. So this was about the India's economic forecast, I would say. So this was a very handy article because certain important terms like purchasing manager index, a fiscal deficit, El Nino, La Nina, core inflation, headline inflation, these are being mentioned here. So we should know all these meaning of all these terms. So we'll meet again tomorrow. Till then,